We've just witnessed a dramatic turn of events. After negotiating to acquire Greenland, Trump has now taken things a step further by announcing that the United States is negotiating for total and unlimited access to Greenland, with the possibility of installing as many military bases there as he wants. And for him, in fact, it's no longer a diplomatic issue here. According to him, it's a matter of national security. And that's not all, because Trump has also sent a very clear message to Europe. If European countries ever start massively selling off American assets, which is the threat they've made, especially treasury bonds, the United States will respond, and quite forcefully. And finally, he also took advantage of the situation to say a few words about, in fact, the famous Supreme Court decision about tariffs. This time, because he hinted that if the verdict doesn't go his way, he'll simply choose another path. So, in other words, the market won't get a break, no matter the outcome. So, one more day, I have to say, where geopolitics is clearly taking precedence over economic fundamentals. And of course, markets never like this kind of uncertainty. But precisely after this rise in geopolitical tension, we're coming back to the macro side, to the US side, because jobless claims have just come out. The numbers have just been released. 200,000 here, while 209,000 were expected. So this shows that the job market remains extremely resilient. We also have the GDP for the third quarter, which shows 4.4% compared to the 4.3% that was forecast. So once again, above expectations. And we also have inflation as measured by core PCE, which remains exactly where the market expected it, that is at 2.9%. So no surprises here, but above all, no sign of a more pronounced slowdown. And all of this shows that the American economy is running strong. And when the economy is running strong, the Fed has absolutely no reason to cut rates. Let me remind you that the meeting is in 5 days. And for now, the statistics show, or at least the predictions, that there will be no rate cut on January 28th. We'll see if things can change. And if you follow the daily updates, that things do change. Not even from one day to the next. Sometimes it's just a minute to the next. And as long as the data doesn't push the Federal Reserve into that corner, it won't budge. It won't move the rates, so there won't be a pivot, there won't be any easing, and therefore no real fuel for risk markets that need that liquidity. And while the US macro environment continues to send signals that keep the Fed frozen, on the regulatory side, we can finally sense things are moving in the right direction. Because we have a SEC, the American regulator, and the CFTC, who have just announced a joint event this time, in 4 days, on January 27th, to work on harmonizing crypto regulations. We also know there's a law that's just about to be signed, but for now, there's still no agreement. It's just about to be signed by Donald Trump. But this meeting between these two giants here, it almost never happens. And the simple fact, thankful, that it's been scheduled says a lot about the current political will. That is to say, we have Paul Atkins, who is the head of the SEC, let me remind you, and Michael Selig, who is the head of the CFTC. These are two people who are very open to innovation, who will try to align their positions precisely to avoid those jurisdictional conflicts that in the past have paralyzed the ecosystem for years. And the objective here is clear. It's to make sure that the United States takes back control, and to become that famous global leader in crypto, which is a slogan Donald Trump keeps repeating. In other words, while macro factors maintain uncertainty and volatility, or even extreme volatility, regulation, on the contrary, is sending a signal of clarity for the future. And that, in the long term, is exactly what institutions are waiting for before accelerating. And in this atmosphere, where everyone is closely watching for the slightest sign before projecting themselves as well, coming from Washington, there's another element that's really starting to get people talking. It's who will be the next Fed chair. It feels like we're in an episode of Dallas with this, because honestly, it's been, 3 seasons now that we've been wondering who will be the next Fed chair, because as you can imagine, it could impact the global market and the crypto market. Will it be someone who is pro-crypto, pro-innovation, pro-blockchain, pro-liquidity, someone who will lower rates? And now we have a new candidate, with the odds now pointing to Rick Rieder this time. It's the first time I've heard that name. Well, it's the first time we've heard about him. He's the CIO of BlackRock. And he could potentially take Jerome Powell's place. And this just hit a new record on Polymarket. And this isn't a name that's been chosen at random, because in fact, this famous Rick reader is known for his very market oriented approach. So he's much more pragmatic, which naturally fuels speculation about a Fed that could potentially be more accommodating to the markets, especially as we approach crucial decisions. So, rate cuts, that's how you should understand it. And when BlackRock starts to indirectly influence this kind of scenario, investors immediately perk up and start getting ready. So, I wanted to talk to you about this new profile, this new candidate for the head of the SEC. Let me remind you that Jerome Powell will be removed from his position. In any case, his term will end in May of this year. I also wanted to talk to you about market sentiment because it's extremely important. You can even trade, buy, or invest based on market sentiment. And it's dropping again, I want to tell you. Well, it's been there for a while, but at one point we came back into the neutral zone. But now it's gone back to very bearish mode, meaning very negative. And honestly, that perfectly sums up the current mood. That is to say, since November 2025, we've been moving within an almost endless range, and we'll talk about that in a moment, where every small rebound makes you believe a real return of confidence before it evaporates immediately, or even collapses altogether. Investors spend their time oscillating between hope, worry, fear, and extremes. In short, right now, we don't really have a clear direction. We don't have a clear direction. We don't necessarily have a clear vision in the short term, in the medium term, and potentially in the long term. It's okay. But it's not just fear, it's real psychological fatigue. I also see it in the comments. I also see it on social media, which I monitor every day in the daily update. Thank you for your loyalty. Thank you to those who subscribe every day and join the community. But in fact, the market is showing rather contradictory signals. Because actually, it's alternating between violent liquidations and very rapid, sharp recoveries. And above all, it's not taking any direction, clear or lasting, as you can see for yourself. Lately, we've had a situation like this that only reinforces the indecision even more. Maybe it's a capitulation by time, by price, okay, but also by time. And so this indecision inevitably fuels volatility. I want to tell you that the more volatility we have, the better it is. Because if we had a boring, non volatile market with no movement and no rhythm, it would be even more difficult. And precisely if right now the market is boring you or making you lose interest, which I can understand, I actually think we're at the best time to invest and have that vision, at least for the coming months. I'm not talking about the next few days, but about the next few months. Clearly, that's what I was reminding everyone about during yesterday's live session with the club we did. And actually, just to make a little aside, you need to have a vision that's different from everyone else's. Because in fact, when you look at a chart, I'll take the chart here, which is available on Kojo in the free chart section. We're going to add more charts here as well. But Kojo, if you're wondering yet, that we launched with my team to help make you a better investor. I'll put the link in the description in case you want to take advantage of. It's not available on the Apple Store or Google Store. It's only available through the link in the description, and we're going to keep improving it. But actually, often people, and this is very important, the message I want to get across here is that investors, especially beginners, will say to themselves, for example, if I look at it monthly, maybe I'll look at it weekly. But actually, every time we see this curve that's red, sure, it's red. But actually, you have to look at it differently from the crowd. You have to see it differently from 90% of people. Because when people see a curve going down here, they think, well, the market is crashing, the market is correcting. I'm not buying, or else I'll buy later when it's lower. But nobody knows. Nobody knows which direction the market will go, at least in the short term. In the medium term as well. In the long term, for me, I'm extremely bullish. In the long term, it doesn't change anything. When it comes to weeks or months, there can be uncertainties. Up until May, or even almost until October, we talked about it during the club's live session. How to prepare for different scenarios and which direction the market might potentially go. The message I want to get across, and this is very important, you can tell me what you think about it in the comments, but the problem, and this is what I was saying to the members of my club, is that actually when you see red, you need to see green. When you see red, you should think, okay, everyone is scared, no one is buying. Is this the time to buy? Have historical facts? Has the past reminded us of the same thing? Did the subprime crisis teach us a lesson? Well, personally, I'm 42 years old. I've lived through several crises, some more severe than others, the most recent ones being COVID in 2020 and the subprime crisis in 2008 to 2009. During COVID in 2020, Bitcoin was at $3,000. Would you buy today knowing that there was a crash to $3,000 for Bitcoin? Everyone. Did you do it? Maybe not. Did 95% of people do it? No. So, yes, sometimes there are liquidity problems, which has been the case for the past 1 or 2 years. There's liquidity at the level of individual investors, but also at the level of companies. But what you need to understand is that when the market goes down, in any case, what I want to share, the value and especially the lesson I want to give, is that when the market drops, that might actually be the time to buy. I'm not giving financial advice. I'm not authorized to do so. That's not the message, but it's the philosophy you need to have behind it. It's that when things are in the red, when we've actually seen Bitcoin at 125,000 and now it's at 90,000, ask yourself the question, isn't that cheap? Is this the right time or are you going to wait? Most people, 80%, it is statistical, it is a fact, I am not making this up, 80% buy at all-time highs, at the ATH, the all-time high. And no one buys at the bottom. But me, I buy even more at the bottom with different levels of strength. By the way, we've integrated different tools with the training portfolio, which allows you to practice with a simulated portfolio, so not with real money, on Kojo. And we also have the strategy observer, and it shows us different profiles, conservative, moderate, aggressive. For now, it's the conservative one that's winning. We've also analyzed and we continuously analyze whether it's worth buying, all at once in lump sum, which is here, or whether it's worth buying using DCA. We're also going to integrate, in my opinion, different strengths and very powerful indicators to know exactly when to buy and when to sell. But the goal here isn't to talk about Kojo. That's not the point at all. I'll get back to the chart, but the idea is to think differently from others. That is to say, when the market is red, you need to think green. In other words, when the market is red, that should be a green light for your investments. Now, I'm not saying to go all in. I'm not saying to go in with full force with your capital right now, because I think that, well, I won't say exactly what I think, but I believe there might be even better opportunities. But the best time to buy isn't in 3 months. It's not in 6 months when we might potentially hit a market bottom. It's now. It's statistical, but it's also psychological. It's also mental. Let me know what you think, and especially if my message was clear, but I had to get it across. Because honestly, it's a shame. There are so many people who are educated in terms of blockchain, in terms of crypto, who understand the theory of cycles, who understand how Bitcoin is going to revolutionize money and challenge government currencies, fiat currencies. But there are very few who actually take action and have a mindset that's the opposite of the masses, of the 95%. Let me know in the comments if you're a part of the 5% or the 95%. But as I was saying, the sentiment, crypto is dipping back into the very berries out. It's precisely while the majority is panicking over the crypto charts. Well, we have American retail investors who are aggressively buying the dip. By the way, I posted about it on Instagram. I was dropping my daughter off at school. I posted a little photo for you. Go check it out on Instagram. It'll make you smile a little. In any case, it made me think. They'll buy aggressively on the famous stock dip, excluding the crypto sector. Yesterday, we also saw retail investors inject. We're talking about 1.8%. Let me go back to the chart here. $1.8 billion into SPY, the S&P 500 ETF. And this is the biggest daily purchase since October, since the famous crash. And it's the third largest since the rebound in April 2025. It's a year. And even more important is that it's not a one-off. It's that since the beginning of the year, retail, meaning individual investors, in French, have bought more than 1 billion euros per day, without exception. And over the week of January 14th, 2026, the total reached $12 billion, with nearly $5 billion in individual stocks. So it's an absolute record over the past 9 months. And if I had to sum that up in a few words, I'd say that retail investors are fully embracing the risk. And often we ask ourselves, where is retail? Why isn't it coming? What is it doing? Well, I'm telling you exactly what it's doing right now in the daily update. And it's interesting. In fact, this is noteworthy because it shows that fear is mainly concentrated in our sector. So here, I'm talking to you about the crypto sector. And if retail investors keep buying stocks in mass, this growing appetite for risk will inevitably spread elsewhere. And you know how it goes. The asset most sensitive to the return of risk on is Bitcoin. So even if crypto sentiment seems to be at its lowest, what retail is doing in traditional markets could be one of the early signals of the next crypto move. I'll talk to you about it in the daily update. But let's move on to another point that really puts a lot of things into perspective, especially in recent weeks. It's that while everyone is trying to figure out where the money is really going since the start of 2026, gold has added $4.5 trillion in market cap. I'm talking about gold here. And silver has also gained another $1.5 trillion. And together, the two of them, precious metals, have absorbed more capital than anything else. The combined crypto market cap, which is around 3 trillion. All right? And in the end, actually, it's not illogical, because when everyone, and especially the world, is shaken, all these hard assets are shaken too. It reassures, it protects, it wakes up. By the way, I'm thinking about making a video on gold very soon. Let me know what you think about that. Is this the right time? Is it a wise move? Are you interested? If you tell me, I'll do it. But this is exactly where the reasoning gets interesting. It's that the world is never static. Historically, when metals attract too much capital too quickly, it's not the end of a cycle, but it's often the beginning of a rotation. Because at some point, money always ends up coming back. Back to what innovates, to what creates value, especially for the future, and to what can scale. So yes, metals have dominated the start of the year, that's true, but crypto remains undervalued, especially considering the speed. And also the structure of the ecosystem. And when the fear subsides, capital never stays where it's hiding. In other words, it goes back to where it can grow. Because people are looking for performance, they're not necessarily believing in a particular asset. And maybe they'll follow the trend once it gets started. In short, lots of things to think about in this daily update. And I actually wanted to add to this reflection with a statement that perfectly sums up the mindset of long-term investors, and which is in complete contrast to the widespread panic of recent days. Robert Kiyosaki has said that he doesn't care at all about gold, silver, Bitcoin, or even Ethereum, whether they go up or down. For him, the strategy doesn't change. I just keep buying more and I get richer. Because yes, when the price drops, when it falls, when it corrects, you shouldn't see it as losing money. You should see it as making money. Because while everyone else is pulling out and thinking about de-risking, there are others who think differently. And that's exactly the opposite mentality of the current market, where a single 1-minute red candle is enough to trigger a wave of fear. But there are plenty of people like that. I know it. Sometimes I meet them, I see in the comments that they say, I don't care, all the better. It's an opportunity. I buy back lower. I buy more. I buy back lower. When the price goes up, there are even some who say, wait, I'm not done accumulating. I'm not done buying. That's exactly the mentality you need to have. So we have Kiyosaki, who completely distances himself from all that. He's been around for quite a while. I don't know how old he is, but maybe 60, 70 years old. And he invested in assets that he considers solid in the long term, without getting caught up in the short-term noise. And it's not the market fluctuations that create wealth here, but rather the ability to act when everyone else hesitates. Let me repeat. It's not the market fluctuations that create wealth, but our ability to act when everyone else hesitates. And I would even add when everyone is afraid. I'll end on that note. See you tomorrow. Let me know what you think. Bye.